So I'm kind of excited that we're having this event on this topic that I've spent a bunch of time thinking about over the past few years. This topic of climate finance and how climate change has the potential to affect and disrupt economic activity, asset values, and potentially financial stability through these two types of risks that we've already talked about today. Physical climate risks, so the physical realizations through rising sea levels, floods, wildfires, etc., and transition risks, so effects that come through regulation on the transition to this net zero economy. And researchers have kind of noticed this important link between climate change and economic activity in financial markets, and have started to kind of compile a whole body of evidence that these climate risks are priced across a variety of asset classes. So we have evidence that climate risks are priced in real estate markets. I've done some work in that direction. Patrick Bolton and Marcin Kasperczyk have done great work showing that climate risks are priced in equity markets. Marcus Painter has really great paper showing that climate risks are priced in municipal debt markets. And you can think about a whole other variety of asset classes, sovereign debt markets, for example, where some countries like the UAE and Iraq will be very much affected by transition risks, but other countries such as Bangladesh might be very much affected by physical climate risks. You can think about crypto assets, the intense energy used to generate and mine some of these, crypto coins, might subject them to, to transition risk, commodity markets, etc. And so what we've done over time as sort of a research body is we've built up this body of evidence that climate risks are priced across this whole variety of asset classes. And I've recently written an annual review of financial economics article with Stefano Giglio and Brian Kelly, where we just summarize sort of that body of knowledge in terms of the pricing of these risks. And that's led people, including Larry Fink, the CEO of BlackRock, to kind of conclude that we need to take climate risk serious. Climate risk is an investment risk. And sort of following on from that, we've had this growing sort of interest in this topic from a whole variety of players. So, Wall Street and financial markets more generally are increasingly worried about these risks from climate change. As a result of that, financial regulators and central banks are increasingly thinking about these links between climate change and financial stability. And I think this is one of the reasons, we're having this conference today, because it is, it is such a central risk potentially that, we really do not understand yet, and we don't understand fully yet. And students are interested in this. So I've started teaching a climate finance full semester MBA and undergraduate class for the first time this semester. And there's lots of interest from students to learn about this topic. I think in part because it is so new and so, and we really are just at the beginning of understanding these risks, right? Now, once you understand that there's this big risk and you start worrying about the effects of that risk on things like financial stability, a very natural, important question is whether or not you can use financial markets to build portfolios that allow you to reduce your exposure to that risk, right? Usually when we start realizing that something, is a risk, we start thinking about risk management. What are the things that we can do to deal with, this new risk? And the challenge we face, both as sort of from the perspective of the financial markets who worry about this risk, but also from the perspective of regulators who worry about this risk, is that there's few, if any, dedicated financial instruments that offer a direct and targeted hedge against specific climate risk, right? So for example, when we think about other types of risks, say, cyber risk, we might try and get an insurance contract against that cyber risk. So that would be, in many markets, insurance is a very effective way to hedge risks. In the sense of climate risk, it's very difficult. In some sense, it's the opposite of an insurable risk. Why? Well, insurance usually works by diversifying across a lot of idiosyncratic shocks. But climate change is sort of the exact opposite of that. So if everybody, who's a homeowner on the Florida coast, gets climate risk insurance, gets flooding insurance, etc., these insurance will all pay out either at the same time or they won't pay out at all. There isn't really a lot of idiosyncratic elements in that type of risk. And that introduces enormous counterparty risk, right? The insurance company that promises to pay you, a lot of money when your house gets flooded, that insurance company in that state of the world will have to pay everybody a lot of money. And, worry about whether or not the company will still be around. The other direction that financial markets usually take when you're thinking about sort of these risks is you're thinking about derivatives contracts, right? So direct financial instruments that pay out, you know, in the event of some realization of climate risk. And I think those derivatives markets have huge potential, but they're currently pretty small and pretty limited. So we have catastrophe bonds as, you know, one type of, you know, financial derivative, you know, financial contract that, you know, does allow, say, reinsurance companies to hedge some of their physical climate risk. But besides that, and a few sort of relatively short-lived weather contracts, we don't have a whole range of existing financial assets out there that allow us to hedge these risks. And so that's a problem. I think that is a problem that insurance markets, that derivatives markets are going to, you know, innovate on over the next few years. So I'm pretty optimistic that they will play, you know, a sizable role in sharing these risks and, you know, and transferring these risks to whoever is most able to bear them over time. But we're just not there yet. Right? And so then the question is, where does that leave us? Insurance contracts, you know, don't work. Derivatives markets might eventually work, but they're not there yet. What are alternative approaches? And so, you know, in some work with Rob Engel and others last year, we proposed an alternative approach. We said, look, let's take something that we know from, you know, from financial theory, you know, that we've known for decades, which is that if you're trying to hedge a risk that, say, might materialize in 30 or 40 years, say some of these physical climate risk realization. An alternative approach is to construct a sequence of very short-lived hedges that hedge news about that event, right? So in some sense, if you construct a portfolio that gains in value every time you learn something bad about climate change, right? Every time you realize climate change is even worse than we thought, the probability of flooding is even higher than we thought. If you construct a portfolio that pays out every time that happens, then cumulatively the returns of that portfolio will actually hedge this realization of the physical climate risk down the road, right? And so that's the insight of this old approach. And so then you can, you know, you kind of transfer this problem of having to construct climate risk hedges into this problem of how do you construct these hedge portfolios? How do you construct these portfolios? You know, and doing that and implementing that strategy, you have to address two questions. Right, to kind of even start thinking about how this portfolio might look, what might be in a hedge portfolio and what might not. You know, again, this is sort of what financial markets are left with at this stage to deal with climate risk and to manage climate risk. So the first problem the first question you have to address, you have to ask, what is the news series that should be your hedge target, right? It's easy to say, well, you want a portfolio that, you know, gains in value every time there's bad news about climate change, but what does that actually mean in practice, right? And so what we did in that earlier paper with Rob is we proposed a way of constructing, you know, a climate news series from, you know, newspaper coverage, textual analysis of newspaper coverage, right? So we said every time the Wall Street Journal, say, talks about climate risk, and talks about climate risk in sort of a negative sentiment, right? That's kind of bad news about climate change. And so a climate hedge portfolio should be one that does disproportionately well whenever the Wall Street Journal on a given day, you know, talks about sort of negative news about climate change. Now, you know, in that original paper, we were very upfront that this was really just a proof of concept. So we didn't really think that our climate news series was the best one you could come up with. And in fact, a lot of the discussion we've had already today tells you that there isn't really one climate news series that is sort of the relevant one for everybody out there. Why? Well, because some people, for example, might be more worried about hedging transition risks. Other people might be more worried about hedging physical risks. And so, you know, some days you might get bad news about one, but actually good news about the other, right? And sometimes when you have regulation today, that's bad news about transition risk, but it's actually good news about physical risk because it makes it less likely that we'll hit some of these very bad states. And so, you know, there's a number of researchers that have proposed various ways of measuring news about climate risks, you know, using textual analysis largely of newspapers, but they become very refined to trying to kind of generate separate measures of physical and regulatory risk, sentiment, and so on, right? So I think we've made a lot of progress on this first question. What should be your hedge target, right? I think that's an important question because it's really only a first step to then try and construct portfolios that allow you to get rid of that risk, to allow you to reduce that risk or transfer it to someone else. The second problem you have is, well, let's assume we have the perfect climate risk news series that we want to hedge, right? So we want a portfolio that does well when, you know, you get bad news about climate risk. How do you construct that portfolio? How do you know how that portfolio should look? Which stocks should you go long? Which stocks should you go short? What other assets might be part of that portfolio? And here you start hitting a wall pretty quickly, because existing approaches to constructing these types of hedge portfolios do not work very well. Why? Because most existing approaches, rely on time series data. Right? We're going to try and look at how stock prices moved in the past when we got good or bad news about climate change in the past, and we'll use that to try and predict how they work going forward. Well, that's very tricky, because we don't think that these risks have been priced for a very long period of time, and so we have only very limited time series to actually do that analysis. And so what are the approaches that people have taken? Both of these, I think, are imperfect. I think they actually generally don't work very well. The first one is people take what we call a narrative approach. What is a narrative approach? You basically don't use much data at all to try and figure out what portfolios you should buy and which assets you should buy and which you sell. You use some sort of beliefs about predetermined relationships that you have about what types of assets you think should do well, what types of assets you think should do badly in this type of climate risk scenario. So for example, one you might say is, you'd say, look, I think solar companies will do well when there's sort of sometimes bad news about transition risk, when it becomes, when the transitions to a low carbon economy becomes faster, because someone has to produce the energy, and if it's not going to be carbon based, where else is it going to come from, right? So a narrative based approach would, for example, tell you we're going to go long solar companies and maybe we're going to go short coal companies. Right? And that seems like a very intuitive and very straightforward way to form these portfolios. But you start realizing very, very quickly, when you look at the universe of stocks, in the US, many, many thousand stocks that you could potentially put into your portfolio, that once you've kind of gone through the solar and wind and coal companies, it actually becomes very, very difficult to predict the direction of almost all of these examples, right? But ideally, you would want to use many, many different assets in your hedge portfolio, because it gives you diversification benefits. So you can try and do something more systematic. So in this paper with Rob Engel, one approach that we took is we said, look, let's try and be more systematic here. Rather than try and guess, let's try and form long-short portfolios on the E-scores from these ESG scores that we've had. The problem with doing that is, one that Monica's presentation, I think, highlighted very, very clearly, is you think, well, isn't the point of these E-scores to tell us which firms are, very green and which firms are very brown? Sort of the clean and the dirty firms. And heuristically, the clean firms should do well when there's transition risk realizations, and the brown firms should be dirty. So that would be our hedge portfolio. But as Monica's paper, I think, shows very convincingly, the required data is usually not available. It's low quality, it's unreliable, and barely correlated across providers. So sure, you can go out and you can form a long-short portfolio based on, your favorite E-score out in the market. But are you really getting what your narrative approach tells you you're getting? Well, in some sense, for a lot of these hedge portfolios, we say the proof is in the pudding. What do I mean by that? We can look what this long-short E-score portfolio, how well that did at hedging these climate news series in the past. And the answer is, it does a little, but it's probably pretty modest in terms of hedge performance. So, in this paper with Rob Engel, we found that these long-short portfolios on E-scores do allow you to hedge, but the hedge performance is really not all that great. And I think most of that is driven just by the quality of the underlying data that you're using to form the long-short portfolios. Again, the second approach that you would take here is this mimicking portfolio approach, which I've already hinted at, which is this idea that, what you want to do is you want to infer portfolio based on past time series relationship between news and prices. So basically you say, look, I just want to look at which stocks did well in the past when we got bad news about climate change, and which did well. And this is an old idea in finance, going back to at least Owen Lamont in 2001, but longer as well. It's a simple regression, and the loadings on past portfolio returns tell you the weights in your hedge portfolio. And again, the challenge I've already mentioned here is that even for time series that have been around and stable for a long time, you have the curse of dimensionality. The asset space is much larger than the number of observations you have in the time series. And so, simple linear algebra tell you that you can basically replicate past realizations of climate risk perfectly, in sample, but that doesn't mean at all that you're able to, do well out of sample. And so, this is a special challenge for climate risk, which was not even priced 10 years ago. So, even for something like trying to hedge, inflation risk or something like that, using this mimicking portfolio approach to tell you how you hedge inflation risk, even if you think that has been around 30 years is tough, climate risk, I don't even know when you want to start thinking that this is something that was being priced. And therefore, it's very, very hard to know sort of how to do the mimicking portfolio approach. So where are we, right? We realize climate risk is priced in asset markets. Climate risk is investment risk. Wall Street is realizing that. Regulators are realizing that. So now we realize we have a risk. We want to do what we do with risk management, which is hedging the risk, transferring the risk to whoever is most able to bear it. How do you do that? Well, I think one place where we've made a lot of progress is realizing that what you want to think about is hedging the arrival of this climate news as sort of a more high frequency series of, that moves much faster than sort of the actual true underlying climate change, which is a very certain and very kind of long, slow moving process. So I think we've made a lot of progress there, but we're still stuck in terms of how to try and actually figure out which portfolios allow you to hedge this well. The narrative approach sounds nice in practice, but we really do not know enough company by company about their climate risk exposures to do a good job there. And the mimicking portfolio approach, again, works well in practice. It works well in theory, has worked reasonably well for other series. But here, because we face this really, really short time series, it's very, very hard to know how to make progress, right? So that's kind of the state of the world we're in. And this was the state of the world when, with a bunch of co-authors, we kind of started to try and figure out, can we do better? What would be alternative approaches to constructing sort of portfolios, or that allow financial market participants to shift risk, away from their balance sheet onto other players who might be more able to hold them. And so we call this the quantity-based approach to constructing climate risk hedge portfolios. So it's a very new project that I think is only the second time I'm talking to people about this, that we're pretty excited about. So how does this approach work? What do we think we can do to try and overcome this problem of having just a really, really short time series? What we do is we propose an approach that's based on the trading responses to news shocks received by some investors. Remember, the big problem with the time series is if you're looking at national news shocks, everybody sees them at the same time. And so you only have one time series of these national news shocks. And so if that's relatively short, you really don't have many data points on which to build your hedge portfolio. Here's what we say. Imagine the following scenario. Imagine that you could observe one specific investor, call them, hedge fund A. And imagine you could observe that every one of the portfolio managers at hedge fund A now receives bad news about climate change. But no other hedge fund managers do. So it's only the hedge fund A managers. If you could go in and you could observe what are the stocks that hedge fund A now disproportionately buys and disproportionately sells after only its own managers received this climate news shock, that would tell you potentially the types of stocks that all hedge fund managers would buy when they receive the global news shock, and therefore kind of be informative about the types of constituents in a portfolio that you would want to put if you were going to try and hedge this global news shock. The really, really nice thing about this approach is if you can measure that, you can use much more information from the cross-section of investors, because in every period, potentially, some investors, if you could observe it, receive this local climate news shock, and they worry about it. And so you have much more data, because in some sense, every investor every investor in every period gives you an observation about the quantity trades that they have, in response to the local news shocks they receive. And that's, even with relatively short time series, that gives you much more data. So that's the idea. Now, implementing this is hard. And so how do we implement this? What do we think we can do? What we're going to do is we're going to look at geographic variation. So in some sense, trying to identify which investors receive news about climate change, we're going to use geographic variation. So imagine in a given period, climate change awareness or concern about climate change only increases in Oregon, up here in on this map. And imagine what we observed is that in Oregon-based hedge funds, Oregon-based mutual funds, Oregon-based investors in this period were more likely to buy solar stocks, right? What we would then, the important thing is We wouldn't observe this at all in the prices of solar stocks. Why? Because Oregon-based investors make up such a small part of the overall pool of investors that this was nothing you would ever be able to observe in prices. But what we are saying is it would still be informative about what would hedge national news shocks. Why? Well, because if all investors receive this news, then the idea is if they behave in the same way as the Oregon-based investors, and that is in some sense our basic identification assumption, then they will all buy solar stocks, and then actually prices will rise. So that would tell us that solar stocks are going to be the stocks that rise in value upon the realization of the climate news series. Now, again, solar stocks, we could kind of guess potentially as something that goes up and goes down, but you can do this for every industry and every stock in principle to learn about, what are the stocks that people buy and sell upon the realization of this news. It has a relationship with the mimicking portfolio approach because the idea is that, in some sense, the national shock will lead to a price response that differs across firms or industries or whatever it is you care about, that is proportional to the demand elasticity to the news. But because we don't have many national news shocks in short time series, we can't really identify that demand elasticity. But the idea is that for a local shock, the local quantity response is also correlated to the demand elasticity of news. So again, the insight is that quantity responses to local news can help us learn about these demand elasticities for different stocks, different industries, which we believe are informative about the price response to global news shocks. Now, how do we implement this? Because what you really need is you now need some shock, something that you believe will move the climate change beliefs or the attention to climate change of a subset of investors in some location that you can identify, but not that of others. Right? And so what we think is that local extreme weather events, such as extreme heat events, will fulfill that role. And so we're going to ask which industries are disproportionately bought and sold in a given quarter by mutual fund managers that are located in areas with heat shocks. Right? We're going to just, for today, I'm just going to show you how this works with industries. But in principle, you can expand this to individual equities, other asset classes. There's no limit to this. Any type of quantity movements that you can observe in the data, if you guys as regulators can observe many more than we can observe in public data. But this is sort of a pretty general approach. So what's the finding? I'm going to preview and then I'm going to show it to you. First of all, we find that long-short portfolios on this characteristic outperform all other approaches to hedging various climate risk news series. So this is really, we think, a substantial improvement in allowing us to construct these hedge portfolios that allow us to transfer risks. In the paper, we also show that the same approach works for hedging national house price and unemployment series. I'm not going to do that today, but we think it's actually a pretty general approach. So why do we think these local heat shocks kind of fulfill this objective that we have? What we need is we need some shock that is localized, right? So that doesn't affect all investors at the same time, but that actually does affect the climate beliefs or climate attention of a subset of investors that are affected. Why do we think heat shocks fulfill this role? It's because this is something that's been documented very widely across a whole range of papers in the physical sciences, where people run surveys of people say, do you think climate change is a problem or not? And then they try and predict what helps you kind of guess who's going to worry about climate change and who's not. And what that literature found is that local heat shocks shift climate change beliefs. So we're going to start with that. I'm going to say, okay, let's see if that actually works. And so we're going to use data to construct 3 different measures of local heat shocks at the US county level. Either did people get injured or die from heat, where there's sort of high crop indemnity payments. This is something that's more relevant in more rural areas, and then also just, did we have sort of just record absolute temperatures where we are? And what's interesting is about these 3 types of shocks is that they're actually relatively weakly correlated. We're going to come back to that. So those places that have high crop indemnity payments usually don't have high injuries or fatalities. Why? Well, injuries and fatalities happen in high population density places, right? While crop indemnity, for example, happens in more rural places, right? So it's going to be 3 relatively independent heat shocks that we can try and exploit. One question you have is this earlier literature, does this make any sense? Like, is the idea that after you've had a local heat shock, a local extreme heat event where you live, does that really shift your attention, beliefs, awareness of climate change? So one way we can test this is we can see whether or not, at the state level at least, Google search volume for climate change increases in those places where we have our local heat events, right? It's, Google searches don't exist at the county level. Otherwise, you could use them directly as your kind of awareness measure, but they at least exist at the state level. And so what we find is that, yes, that is actually the case. The quantities here, are sort of hard to interpret, the coefficient quantities, because of the way this Google News measure is scaled. But what you find is consistently across all three of our local heat measures, we find that after a state has had one of these heat waves, search volume for climate change on Google goes up. So that's at least consistent with this earlier literature that has found that these types of extreme heat events really do shift the beliefs of individuals living in those locations. So then the question we want to ask is, okay, if we think it shifts beliefs, want to figure out which assets are disproportionately bought or sold by mutual fund managers exposed to these heat shocks. So again, what we're going to do is we're going to focus on equities, but in principle, you could do this for other assets. We're going to focus on just 24 industry portfolios. So we're going to try and figure out which industries are bought and sold rather than which individual stocks. But again, you could do it for individual equities. It gets a bit noisier, obviously, because it's much sparser holdings for each stock. But there's no reason this couldn't work. And we're going to use pretty standard data to measure, US mutual fund holdings. So this is going to be mutual fund managers. Why? Because for those at a quarterly level, we have the entire universe of their holdings. And with, some actually pretty annoying data merging and data work, we can find out where the manager of each mutual fund is located, right? So that kind of tells us, merging it then together with this heat shock data kind of tells us which mutual fund manager just lived through an extreme heat event, to then try and look at which industries they ended up buying and selling. What's important for this to work is that these mutual fund managers have substantial geographic dispersion. So this gives you a sense. I mean, they're generally concentrated in places with sort of high population places. But overall, we have, out of the 2,500 unique mutual funds, they're in about 280 unique counties, and they're relatively spread out across the US. And so this example of, Oregon gets hit with a heat wave, we can then look at these Oregon-based mutual fund managers and see how their trading works differentially. If every mutual fund manager was just in New York City and Connecticut, we would have a problem because we would have no spatial variation that we could exploit. But because these mutual fund managers are located, relatively dispersed throughout the United States, the fact that these heat waves, hit some part of the country, at one point in time relative to another, gives us that variation we need. We're then going to just calculate these active changes, industry by industry in the holdings of, a mutual fund, in a specific fund. And then what we're going to do is we're just going to regress industry by industry the active changes of that fund, on time fixed effect, and a bunch of other fund level controls, but also just this dummy variable on whether or not this this mutual fund manager just went through a heat wave in the location where they live. And these beta coefficients are going to end up being the portfolio weights in our hedge portfolio. So a stock that mutual fund managers buy when they've just lived through a heat wave, those stocks are going to be long positions in our hedge portfolio, because we think when there's national bad news about climate change, everyone is going to buy these stocks, and we're actually going to have that hedge portfolio increase in value. So that's the approach that we have. Now, one of the interesting things that we have is that when you look across our three different heat shocks, the one based on fatalities and injuries, the one just based on temperatures, and the one based on indemnities. I told you before that those heat shocks are almost uncorrelated, right? So it's not that it's always the same places that get one type of heat shock versus another. When we look in the data, we find that they pick very similar hedge portfolios. So the types of industries that mutual fund managers in rural places where they've just had lots of crop damages buy is very similar to the types of industries that mutual fund managers in cities where you've just had lots of injuries and deaths due to heat buy. Right, so that's kind of the first bit of evidence just from this data that we're not just picking up noise, but that there's some actual signal in what we're picking up. Just to give you a sense of how these industries look and how those portfolios look, just focus on the first column. We've ordered sort of industries by those that are sort of, the biggest long positions and the biggest short positions. And I think one key takeaway from this is really not what I would have expected. And if you look at this, who is the number one? It's auto industry and auto components. I would have thought well, they're really strongly affected by transition risk. Right? I always thought the auto industry might be in trouble. Another long position in its portfolio is the energy sector. Now, in the US, this energy portfolio is largely made up of big oil majors. Again, I would have thought that those are firms that would actually lose from transition risk, right? Now, when we saw this, we were like, okay, this approach is not going to work, right? Even though it actually seems like, it's this, they're correlated. So it's, the people with the fund indemnity, with the insurance shocks, buy the same ones as the people with the energy, with the death shocks, which would kind of weird if there was not some signal in it. We're not going to get this to work if we're going to go long energy and long car, right? Turns out we are. And this is, I think, one of the big takeaways for us here, which is the alternative would have been the mimicking portfolio approach. And the mimicking portfolio approach might have told us what we need to do is you need to short the energy sector. And part of the reason the narrative approach doesn't work is because my guess about the energy sector being one that loses from a transition to a renewable sort of energies was wrong. Now I'm trying to figure out why it's wrong. And I've talked to a bunch of people and I'm trying to figure out why do they think the energy sector may actually benefit. Now here's one story. Is it the truth? I don't know. But they said, look, I actually think there's going to be so much federal funding in this green transition. This is now specific to the US. We have an infrastructure bill with more than $1 trillion. So much taxpayer money is going to go into this transition. There's going to be so much money. This isn't all going to be picked up by small solar startups. There are not enough of them around. And the scale that we need to get to can only be done by the existing energy majors. And I just don't believe that Exxon, with this lobbying on Capitol Hill, will not make sure that they get a huge chunk of that, renewable energy taxpayer money that's going to go into this. So I think, as always, when there's a transition, I actually think the incumbents may gain. Right? That's not the Schumpeterian, creative destruction world, but it's one where you think, look, these industries are so concentrated and so non-competitive that even if there's a big transition, say, from combustion engine to electric, it's still the same 3 car companies that are going to build the electric. And if there's a lot of federal money going into this, maybe they're going to gain. This is just to say, we started here and we thought we're dead in the water. There's no way that this is going to be a good hedge portfolio. And we're surprised to see that it is. And I think it kind of tells you the strength of this approach relative to, the other approaches where we would have just used common sense, quote unquote, to try and guess what those portfolios would have looked. So again, the portfolios are then just simple. They're just these loadings. You go long the stuff that mutual fund managers buy after living through local heat waves, and you go short the rest. Okay, so now let's see how these portfolios do in terms of hedging these national news series. I told you before about sort of the approaches that people have taken to build these national news series. And again, different news series capture different types of climate risks. What we do in this paper is, rather than take a stand on like which news series is the best, which is the worst, what we're going to do is, let's say, we're going to take 15 different news series and we just see how well we do hedging against all of them. What are we going to use as our measure of how well we hedge? It's an out of sample correlation. So basically, we're going to construct our portfolio with data we have until today. We're going to construct a portfolio. Then we're going to look, how does that portfolio perform next period relative to what news we observe next period? And then we're going to use we're going to form a new portfolio in the next period because we have one more data point. And we're going to go do the same exercise. So this is not using data from the future. And therefore, these out-of-sample hedges approximate the performance that's achievable in real time. Right? So this is something that a hedge fund or a manager could have done in real time. So we're not using any future data. Again, there's lots of these different types of climate risk series. I'm not going to go in detail through all of them. They're looking at different sentiments or, looking at sort of general physical transition risks, etc. In the paper, we describe them all in detail if you want to figure out what's going on there. We don't think there's a good reason to think one is better than the other. So rather than doing that, what we think is let's just look at how we do with all of them. Okay. So here's a graph I'm going to show you, and this is going to be sort of the main results slide. And then I'm going to conclude. So what I'm showing you here is a correlation. In the different rows, I'm going to use different ways of constructing hedge portfolios, different ways. In the first row here, I'm just using the hedge portfolio that's built when we're using the heat fatality injury indicator. So this is a portfolio that just goes long the industries that mutual fund managers that have just lived through a heat wave buy and short the stocks that they sell. And I'm plotting the correlation on the horizontal axis. Each dot here will correspond to a different climate news series. So here you'll see, the Ardia et al. One. Here's one Engel et al., our own first paper. Here is Faccini et al. Here's Kelly et al. Here's Google, and here's temperature. Here's all of them together. So not picking which of these series we think is the best or the worst one. Again, depending on what it is that you think your portfolio exposure is, you may want to pick a different one. For each of these, we get a positive hedge performance. On average, we get an out of sample correlation with the news series of just under 18%. This is one of our heat shocks. How do the other two look? Reasonably well. Let's now look at how this performs relative to other approaches. The first one I said would be this narrative approach, right? You just guess what can do well. And so here's a bunch of ways we thought an industry person might do. It says go long a clean energy ETF, go short the energy market, go short the stranded asset portfolio, or go long short an e-score portfolio. These would all have been ways, as I discussed before, that you might have guessed you can hedge these new series. How do they do? I mean, long PVD, the clean energy, probably still does the best, but for many of them, you barely generate any hedging. If you short the energy market, you actually get negative correlations. That's consistent with what I showed you before. It's actually the hedge fund, the mutual fund managers, they go long the energy market when they worry about climate. I would have guessed you would have to short it. That would have just been my guess. But it actually turns out when you look at the quantities, they tell you they go long. What about the other approach, the mimicking portfolio approach, the data-driven one, where you try and learn from the past correlations to teach you about future correlations? That approach works even less well. Basically, you get correlations around zero. Why? It's because you have so few data points in sample that yes, it's barely possible to recover any information from that, right? And this is, I guess, what we started out with, why people were so frustrated about the existing approaches to be able to hedge these climate news, and why we think that this new approach, this quantity-based approach, really has the potential to help here. So I'm going to conclude here, and then I'm going to have a more general discussion both here and then in the policy panel. So what we do in this paper is we kind of start from this observation that I started out with today, right? We have a bunch of literature, a bunch of papers, a bunch of research now that shows that climate risk is priced across a whole range of financial markets. And we know that financial market participants worry about climate risk. Right? They want to get rid of it. They want to hedge it. They want to transfer it. They want, and in many ways, this is one of the fundamental functions of financial markets. Right? One of the main things that financial markets should do, it is transfer risk to those people that are best able to hold it. And I think it is something that regulators worry about. And again, I think it's going to be a central theme in the policy discussion also. If you look at your banks or you look at your mutual fund companies, what you worry about is that some of this climate risk might be concentrated in a subset of these companies. And you want to think about tools to offer them to transfer those risks, to buy hedge portfolios, to reduce these risks in their portfolio. But you have this challenge that you either have to guess which stocks are positively or negatively exposed, or more importantly, not just which ones are truly positively or negatively exposed, but which ones managers think are positively or negatively exposed. Because here's one important thing: even if the energy market will end up losing from a carbon transition, as long as every mutual fund manager thinks they will win, holding them is still going to allow you to hedge, right? At least for at least in the short to medium. And so we say, look, how do we overcome this short time series problem that we have in our standard risk management tools, where we use past data to learn about the future, past price data to learn about the future? It's by using past quantity data in addition to past price data, exploiting the fact that the cross-section gives us a lot of additional data points, a lot of additional power, to start learning about what it is that mutual fund managers think are stocks that will help you hedge. And again, the finding we have just summarized in that dot plot I had just up is that these long short portfolios on those stocks and those industries that are bought after these localized heat events perform better out of sample than any of the existing approaches to hedge climate risk news series than we've seen. And so, I want to kind of to say this is again just it's something we view this as a proof of concept. There's probably a lot of additional directions you can go. Again, you can go from industries to stocks. You can add other assets to this. It's a lot of directions you can go here. And I think more generally, I think it's exciting to see the papers on the program today. It's exciting to see many students, and many researchers at central banks starting to think about climate finance as a research field. I think it's a super exciting research field. There's lots of work to be done. And, I'm kind of hoping that cumulatively and jointly, we can, get to a point where we understand this risk as well as we understand some of our other risks in the economy. And then, we can kind of understand the extent to which it constitutes financial stability risk. I guess John Cochran would say just because someone will lose money is not a problem. And I think that's largely correct. But we don't know if the only thing that will happen is some people will lose money, who will lose money by how much. For that, we need to understand the risks better, the risk exposures better. I think this is one approach to help us learn more about this, but there's also many others. So I'm going to stop here and see if there's, any questions or, anything else. Thank you.
Thank you, Johannes. I will open now for a few minutes from questions from the audience. I would like to put up a question myself. We have seen in previous decades that financial markets have been very creative, creating new instruments. So I was going to ask you, how do you think will be the creation of climate change instruments, whether ETFs, mutual funds, and, to capitalize on all this creativity that has been going on?
Yeah, I think the big challenge with financial instruments is also measurement, right? So, when you think about things like catastrophe bonds, right, which I think are probably the closest to a financial instrument that hedges climate risk. So catastrophe bonds are basically, issued by reinsurance companies. And, if climate damages, reach a certain level, then the reinsurance company does not have to repay the bond, right? So it's sort of a automatic recapitalization upon the realization of a big climate risk. That I think is a great idea. The problem, even for something like that, is how exactly do you measure these, climate damages? And you have lawsuits, and it's kind of a big problem there. And I think that's for something relatively straightforward, which is physical damages from climate risk, say after a hurricane or something like that. We might actually think that ex post we'll be able to kind of tally up the damages quite well. It gets much more difficult to try and define like an event for something like transition risk. Right now, one example that there is an ETF, KRBN is the ticker, which basically what it does is that the idea is it's just an ETF. I think it's either ETF or mutual fund that tracks in value the weighted average of carbon prices on 3 exchanges. There's a kind of a carbon trading market in Europe and and 2 in the US. And the idea is that they buy and sell certificates in a way that when certificates gets more expensive, this mutual fund goes up in value, right? So that might be, again, one other example of a type of instrument that you could think might allow you to hedge transition risks, right? Because the idea is when we have more transition risk, probably the price of carbon will go up. And so if you hold that, that mutual fund, you're going to make money. So those are sort of 2 examples on the physical and transition risk instrument side that I've seen that I think are kind of great examples of where this can go. And, I think as carbon markets develop everywhere, I think derivatives based on that seem like a very obvious way to kind of hedge transition risks.
I would also like to ask you, Johannes, and your co-author, Robert Engel, who is now with us, whether you think regulators or even multinational institutions like the World Bank or the IMF have some role in sort of creating these climate change instruments.
I think to some extent, like take something like the cat bonds. I think the World Bank actually issues some of them because they, when there's sort of climate disasters in some countries where the World Bank will then help, rebuild. It's exactly that type. You would think that they're exactly short the type of, the type of climate risk. They're kind of exactly have this physical climate risk exposure that that would make it attractive to issue a cat bond. I don't know what role there, because in the end these will be traded on some national market, right? And so my sense is that the CFTC in the United States, which has actually been a leader in thinking about climate risk in the US financial system relative to other agencies in the US, would play, I think, a first order role in trying to sort of create derivatives markets that work there. I don't know if there's derivatives markets where the regulation is supranational, but in the end, I think you need to create a legal framework and a legal environment where these can trade on some national market. And once you have that, I mean, in principle, you could trade global exposure on the US market, or whichever market is the first one that kind of creates the framework for people to do it. I don't know, Rob, what your thoughts are.
Robert, you are muted.
How about that? Can you hear me now? Yes. I think one of the places where we're going to see some real interesting movements in asset prices linked to the climate will be the market for carbon offsets. And this is going to be a global market. It's going to involve emerging markets very heavily, because often the kinds of offsets that are likely to be important are forest-based or nature-based of one kind or another. And the need for these offsets is just going to grow astronomically because of the commitments to net zero that are being made by companies and states and subnational regions and firms all over the world. But of course, the problem with these markets is that it isn't clear what is a legitimate and defensible carbon offset. You'd like a carbon offset to have the role that a carbon offset, a ton of a carbon offset is just as good as a ton of emissions reductions. And there are a lot of ways people doubt whether that's really true. So in any case, this is a market that needs a lot of supervision, a lot of regulation, but it is, I think, going to be a big global market that is an important way carbon is going to be priced.